So, everyone, I just want to start by just saying thank you to all of you. I know 8 o'clock on a Thursday morning can be very busy as we're trying to wrap up things for the week, but I just want to just express my appreciation that you're here today joining us for Cinnabar's quarterly webinar. Whether you're one of the valued clients, the investors, or one of our advisor partners, I genuinely am appreciative for you all being here today. At Cinnabar, we're constantly looking ahead, trying to make sure that we are positioning portfolios for what the future cycle has been. So despite doing well over the past performance, we want to make sure we continue to deliver those returns to you today. And so got a really awesome agenda lined up that I'm sure a lot of you are going to get a lot of actionable insights from, as well as find it quite refreshing. So today's agenda is we're going to get the numbers out of the way. We're going to start talking about the fund performance. I want to give those people who are invested into the funds an update on how the local funds are doing, a little recap on a fund manager we introduced to you last quarter, and then also we're going to talk about the global performance as well. After that, we're going to talk about shifting market conditions. I'm sure there's so much volatility, so much up and down at the moment, lots of news headlines coming out, and we're going to start digesting that and seeing how a little bit of a look behind the scenes as to how Cinnabar positioned on the back of that. After that, I don't want to just give you a presentation. I want you to have something tangible that you as a client or as an advisor can walk away from today with, having some key action points for your portfolio to at least see, are you thinking about all the possible risks that are out there. And then lastly, I'm going to have the pleasure of introducing you to a partner, Pacific North or South, and their expert or portfolio manager and partner, Kamil Dimmich, who is the portfolio manager on those emerging markets, and he's going to be coming and giving us his view on EM. And so that's really, really exciting, and it's something I'm truly looking forward to hearing. So if you haven't already, I hope you've got a cup of coffee ready, ready to tackle today's work, because pretty exciting presentation ahead. If you have any questions, Q&A bar bottom of your screen, just pop it in there, and then we'll answer questions as we go throughout. There will be a dedicated Q&A section after Kamil's presentation, but if there are any questions throughout that you want to raise, please feel free to do so. All right. So I come to you, and again, getting to speak about our local fund performance really is becoming a bit of a privilege at the moment. They're performing incredibly well. A lot of that is down to what we focus on getting most of the time right, is that's our asset allocation. And we look at our local funds over 5-year returns. They're producing outperformance over their peer group averages. And so that's what we're doing. We're cognizant that we don't focus everything around peers, but we want to make sure that you as an investor are getting returns that are competitive and over the long term start producing a little bit more performance for your retirement savings. And so when we look at that over the short term periods and we look at our quartile rankings, which is down here at the bottom, you see lots of number ones. And so that is kind of a lovely pat on the back for the Cinnabar team, because if you're a number one, that means you're in the top 25% of funds. And so over most periods, over all periods, we're either second or first quartile across the range of funds. And it's really just a testament to get your asset allocation right, and your long-term returns are largely taken care of. But there has been some active decisions that the Cinnabar team has taken, has resulted in these performances. The first, on the more defensive side of things, is what we've done is we moved towards high duration fixed income. And so what essentially happens with these high duration fixed income instruments is, as soon as interest rates come down, those bonds start to reprice, and you start getting some performance out of that. And so that's generated quite a bit of returns for our lower risk portfolios. And then in the more aggressive portfolios, what's kind of driven a lot of our returns has been the allocation to gold and resource stocks, as well as some of the SA equities. They've added quite a lot of value ahead of all this geopolitical tension that we've seen. And so this has resulted in very strong performance. And kind of touching on that gold and resources and how we've gone about basically allocating to that is the Tiger BCI Worldwide Flexible Fund. So for those of you that were at the previous quarter, quarterly, you would have heard that lovely man on the right, Carl Eisenhinker, speak about his portfolio and how his fund is done. But just for an update, how this fund is designed is it's essentially designed as a geopolitical conscious fund, and it's meant to benefit as geopolitics rises. This fund, with its allocation to gold and resource stocks, positions itself for any kind of geopolitical flare-ups. And so, since adding it into the portfolios, it was originally just in the Balance Plus, but it's subsequently been added into all of the local funds, other than the income fund. It's already added stability when the markets have shown a little bit of ambiguity, and then it's also provided some nice upside performance to the local portfolios. And so last time we spoke about it having 40% returns over a year, but I'm happy to say that Carl's kept working hard on the fund, and the recent performance has really just taken off. Over 1 year, compared to peer group average, it's outperformed by over 46%, delivered almost 58.71%. And so it's been a big kicker, even though it's only held in small allocations in our local funds. It's produced nice levels of alpha. And obviously, when you return levels of return like this, there's naturally the competitive part comes out, and you start looking at just what the returns ranks were. So over 1 year, Carl's fund is now first out of all worldwide multi-asset flexible funds. And even over the short term, he's third. And so this is out of 122 funds. So it truly just shows you that the local funds are built with really top-class fund managers that are able to build a bit of protection, but also capture on the upside for the local funds. The story is quite similar for the global funds as well. Our global balance fund, so this is just for a moderate offshore investor, has done almost 15% last year, and over 3 years it's done 12%. So very strong returns, especially looking in the offshore space. Again, looking at quartile rankings, we see that only one period are we third quartile, but other than that, it's kind of compounding the consistency and first quartile over 3 years, which is great because that's the period we look at when measuring the average time horizon for an investor in this fund. So really, really strong performance there. A global equity fund is our newest fund that we added last year. So it's a bit over a year now, year and 3 months now. And it's done incredibly. Since launch, it has done 17%. Over 1 year, it's done 21%. And this year today, it's in the first quartile. So this fund has also done incredibly well, better than we could have hoped for as a start. And so what's driving the performance of our global funds? It's largely been down to, again, smart asset allocation in the balance fund, getting our major asset class calls correct there. Prioritizing quality fund managers in our global equity allocations, and then also a early inclusion of emerging market specialists into the portfolio that have captured this upswing that we've seen recently and kind of sets the basis for today's discussion. And so it's important to say that an inclusion to this EM manager wasn't necessarily just a random addition. We're always watching for meaningful shifts, and there's one that stood out quite clearly. So what I want to take you through today is a ratio. This is a chart, and we don't have to get too technical on how it's worked out, but essentially this is showing us the emerging market index versus the developed market index, and then a ratio between the two. And so how you look at this is you say, if blue line goes up, it shows your emerging markets are outperforming. If blue line goes down, developed markets are outperforming. And what we can see is that if you look at it over a long enough period, you see that there's definite sign of cyclicality here. We see up into the late 1900s, emerging markets outperformed before that came down, and it's cycled and cycled all the way up until where we are 2010. And ever since then, this ratio has been falling. And this has largely been down to developed markets. Largely, the US have been in charge. But it's important to say that these cycles don't last forever. It's often when it's least expected that you see a turn in this ratio. And so what we did, we spotted the signs early and identified the need to position for potential reversal. And that's why we brought in a EM specialist to make sure we're we're ready for when this next wave starts building. And so what we do when we zoom in just a little bit closer and we just look at the last few years, we see two things. We see what looks to be a crocodile jaw that's split open. And that's largely just a reference to the split between what the returns have been ever since COVID of the black line versus the red line. So the black line is all your developed markets and your red is your emerging markets. You see that since COVID, emerging markets really haven't done much, whereas developed markets have. And one of the major drivers that we've come to conclude with is that after COVID, the US, because they're such a big part of developed markets, their option was just to produce massive stimulus as soon as COVID came, just pump money into the economy, give stimulus checks, increase spending to try to boost the economy. Whereas in emerging markets, especially countries like China, they were a lot more cautious and a lot more repressive when it came to policies there. And so developed markets picked up from the stimulus, but also in a world of lockdown, there was a massive tech boom that kind of that came as a result of lockdown. We saw AI pick up, cloud infrastructure. We saw streaming and e-commerce really start taking off, and developed markets in the US specifically were positioned very well for this boom that were to follow. And so naturally, in a period like this, US firms dominated, huge investor money flowed into these top companies, and their earnings naturally reflected this increased excitement around these big tech names. Whereas the red line, we've obviously touched on, they had slower, more restrictive policies. They were a lot slower to come out of lockdown as well, and so naturally the reopenings were slower. But the important point is, if we looked at the graph before and this graph below, these jaws aren't always going to stay open. They're going to close at some point. Some point, EM will return and revert back to average. And so there's either two ways it can happen. It's either DM does worse, developed markets do worse, or there's a recovery in the emerging markets. And so that happened last year in our view. There was a turning point in 2025, where for the first time since 2017, emerging markets outperformed developed markets. Emerging markets did 34% and developed markets did 21%. And a large case as to why investors are rotating into emerging markets is much cheaper stocks that you can get in countries like China, where it's almost 40% cheaper for an equivalent US stock. So you're getting cheaper valuations, you're getting improving and more accelerating levels of growth in these emerging market regions, with EM predicted to grow 2% more than developed markets. And then a lot of the geopolitical pressure and all the tension that's kind of flared up is adding further tailwinds to the shift. And so that's why we saw this trend happening and decided to act early and bring in an emerging market manager. And so it's important to note that shifts like these don't happen in a vacuum. What we're experiencing at the moment, what we're living through, is a much more multipolar world where geopolitics is going to continue ramping up, and it's gonna affect everything. The recent examples truly make it real. For example, the escalating tariffs that are disrupting global trade. We've got the ongoing war happening in Iran now, and that's pushing up energy prices and petrol prices as well. And then the US's capture of the Venezuela's president earlier this year, shaking up Latin America. And so it's important to know that these aren't just headlines, but they're actually showing up at the petrol pump. They're showing up in supply chains for everyday goods. And as a result, with all the kind of new news flow coming in, there's creating a lot more ups and downs in the market portfolios that can hit your retirement savings. But it's important to note that when you're investing, that the US is still a powerhouse. They've still got the tech leaders, the big companies are still set up there. They're still the reserve currency, and their consumers are still relatively strong. So it's not possible to just walk away from it. And so you can't just not invest into the US. But in an environment like this, in this multipolar environment, the smart move is going to be allocating to active managers who can find you value outside of those big tech companies in the US, as well as making sure you're diversified. And so that's what we're focused on doing at Cinnabar in our portfolios, is building portfolios that can handle all of the uncertainty and still make sure to capture growth where it's emerging. And so I want to make it a bit practical. There's 3 clear takeaways that I think would be important for you as a individual investor, or if you're an advisor. And that is to make sure you are prioritizing meaningful global diversification. Make sure you are balancing the benefits of the US strength, but also with making sure you diversify across other regions, make sure that your EM is part of your portfolio, so you're not too reliant on one single economy. The second action is lean on active managers in volatile times. I think in an environment like this, the difference between the winners and the losers are going to be as great as they ever have been. And so active managers have the ability to pick where to take the risks and where to find the opportunities. And it's through that we believe active management is best suited in our global portfolios at the moment. And then lastly, it's often the thing when it feels wrong, that's probably the time to do it. But it's always to position ahead of the turn. Don't wait for the headlines, because at that point it's probably already priced into markets. And so these are the real actionable steps that we take in our Cinnabar portfolios. And I encourage clients, if you hear, bring these to your advisors, and advisors use these great points to discuss with your clients during a review meeting or just an any-day call. Through this, you can build resilient portfolios. And so that's the practical side. And it's exactly why we brought in a specialist, an emerging markets manager, to handle this whole macro backdrop and all of the volatility that's going on with real expertise. Because no 2 emerging markets are the same. Some offer huge value at the moment, some carry real risks. And so that's why we employ active specialists in the Cinnabar funds to make sure that they can differentiate between the 2. And so that brings us perfectly onto our guest today. Pacific Asset Management is a London-based asset management firm that employ with a sharp focus on emerging markets through their North to South brand. And the man we have here today is Kamil Dimmich. He's a portfolio manager and partner of North to South Capital. He's got over 27 years of experience, but over 15 years of experience in blending big picture themes with deep company research to find opportunities in emerging markets today. And so I bring the timing of having them speak today is great for him because he's got something very, very great to present on in terms of performance. And we've got a great story to tell you as well. This is since initial investment. So we've been invested with them for just over 6 months now. And the returns have been staggering. Emerging markets, as we've touched on, have done incredibly well over the past 6 months. But Pacific North to South have shown that they can add value above what the index does, which is not necessarily the case for a lot of developed regions. And so they produced over 10% outperformance in 6 months there. And so we could not be happier with the funds, with them being included into the portfolios. So it's at this point I'd like to say, Kamil, thank you for joining us. I mean, we're all very much, myself included, looking forward to the insights that you have to offer. So at this point, I'd like to hand it over to you.
Great. Thank you, Cameron. I have one slight problem, which is I know you saw me just earlier, but my camera seems to have gone haywire. So I'm afraid you might not be able to see me, but I do have a presentation that I'd like to share, and I think you're probably best focusing on that anyway. So many apologies. This is one of those last minute problems. If I can just bring this up, and hopefully you can see the presentation.
Yeah, I can see it.
Great. So again, apologies that you can't see me, but take my word for it, there isn't much to see. So I'd like to, thank you very much for the introduction, and obviously thank you very much for your support and your investment. We've been doing this for a long time, and we've been working with many of our investors for many, many years, which is a real privilege. And so hopefully this relationship will also last for a number of years and market cycles. But what I'd like to do today is just give you a really quick 2-minute background on North of South, and then talk big picture emerging markets, just following on from some of these comments, where we think we stand at the moment, and then talk a little bit about positioning, and then open it up for questions, really. There's obviously a lot going on. I am actually based in Dubai, so I'm witnessing a lot of what's going on myself from a very real-time perspective. And so, yeah, happy to take any questions, obviously, on how we're thinking about the current situation. But I'll start off really with a more general picture. So just in terms of North of South Capital, we are a long-established emerging markets equity boutique. We cooperate with a firm called Pacific Asset Management, who are a wider, more diversified business. I won't go into all the detail, but we are clearly one of their flagship funds. But we, North of South, operate as an independent firm, and majority owned by the partners. Where you guys are invested is the global EM equity strategy. This is a more liquid version of our original all cap strategy, which we launched back in 2011, and which is closed, has now for a couple of years been closed to new investors because the smaller cap end has been constraining in terms of the amount of money we could accept in it. And hence the idea to launch this more liquid version, which actually has been performing better in recent years, given the strong performance of the larger and mega caps. So that tilt has actually worked in your favor. The goal here is really to outperform the MSCI Emerging Markets Index by about 3% annually. We have exceeded that in our history throughout the years, and so look, past performance is no guide to future performance, but we do think we have a fairly robust process that helps us outperform through very different market cycles. The team has been working together for many years, and I joined North of South in 2009. Most of the rest of the team, while they may have joined later, are people that we have collectively known for many years and worked with previously. So it's a very tightly knit team where everyone really understands what they're doing and what we're trying to achieve. And what we're trying to achieve is our strategy is based around value investing. We are always buying stocks that we think trade below fair value, and we hope to outperform in that way. But value investing in emerging markets and global emerging markets, with the various different risk profiles of the markets we invest in, does require more finesse than just running screens for low PE stocks. That's not a strategy that has worked consistently over time. And so really what we do is a blend of value with a quality focus. You could almost call it a quality value investment style. And we also use the cost of capital as a key pillar of the investment process. So we think very carefully about the opportunity set in terms of fixed income in each of the markets that we invest in. We like it when the cost of capital declines. You guys, obviously, I don't need to tell you about this. In South Africa, you're seeing a decline in that cost of capital as bond yields are tightening. We generally think that is favorable not only for the market itself, for equity valuations, but also for the currency. And so I'll give you a couple of sort of examples of what's been happening in emerging markets and why we think that is a very strong tailwind for our markets. So in terms of this big picture EM context, straight into this idea about cost of capital. So we are currently in an unprecedented situation where the kind of blended policy rate and the blended domestic bond yields in emerging markets, and we're looking here at MSCI emerging markets, market cap weighted to reflect our investable universe and the index, that cost of capital has converged fully with developed markets. In fact, it is lower than it is already lower than in the US itself. In a blended fashion, it's pretty similar to developed markets. And so one of the things we had always said historically is emerging market equities should always trade at a discount to developed markets because they face a higher cost of capital, therefore a higher discount rate. This, of course, reflects the higher risk within our markets, and a discount is always appropriate. Arguably, this sort of almost certainty is now under question. Perhaps the discount should be at a minimum narrowing. I wouldn't go as far as saying it should disappear, but it should definitely be narrowing. And you can see here, some examples. Places like Korea, Taiwan, China are now the dominant markets within MSCI EM. These are all markets with very low cost of capital. It means companies can fund themselves very inexpensively. It means that domestic investors do not have attractive alternatives to achieve an ongoing fixed income yield or return. There are, of course, exceptions. We have Brazil in there, which remains a classic emerging market. But you have to keep in mind that Brazil today is only about 3 or 4% of the index. This used to be the biggest market in emerging markets 20 years ago. Latin America was probably 30, 40% of the index. And generally speaking, we were facing a very, very high cost of capital. So this is no longer the case. And the implications of that are quite significant. This is a slide I love. This is put together by UBS, shows annualized returns from a selection of markets since 2007, so since the pre-crisis peak. And we can see here it's been decomposed into 4 components: earnings growth, dividends, currency movements, and PE expansion or contraction. So whether the market has over this time become more or less expensive. And we can see the US, of course, is the best performing market, although very, very, very close to Taiwan, and actually probably depends on the day you're looking at. If you update this, we might find that Taiwan is actually ahead. The US growth has been driven, we can see the pink bar, primarily by earnings growth, which is great. The US has delivered higher annual earnings growth than any other country, and a little bit from dividends. And then there has also been a multiple expansion, that green bar. And of course, there's no currency effect because we're measuring everything here in US dollars. Now, what you will see, which is very clear, the blue line is almost universally negative. So currency has been a drag on practically all emerging markets. At minimum, it hasn't contributed positively, but it's mostly been a drag during this period. So your returns as a US dollar-based investor, or really any sort of investor, have been dragged down by an ongoing devaluation of the local currencies. And so the value of your cash flows, of your earnings, of your equities have declined, even if earnings have grown, and have reduced your total returns. Now, that is something that we expect and predict. As I mentioned earlier, we think that countries where you have a high domestic cost of capital are going to see currency depreciation over time. So you can think of it almost as the opposite of the carry trade. The carry trade works very well in the short term, where people get paid an additional yield for the risk of holding that currency. But eventually those currencies do depreciate because there is no such thing as a free lunch. And so that's been the history here. But as I pointed out earlier, we are now in a world where emerging market yields are very similar to those in developed markets or in the US. And that argument no longer necessarily holds, that you are going to expect this ongoing depreciation in the currency, because there is no free lunch. You're not being paid extra for risk in the fixed income markets. And conceivably, this is because these markets have been de-risked. And I think we have a couple of slides later on that. But essentially, emerging markets are largely running much stronger fiscal positions, much stronger current account positions, and simply look healthier on many metrics than developed markets. The second point that I love to make from this chart is when you look at the yellow bar, the contribution to returns from dividends. In the US, it's not particularly significant. It's been a small positive, but in most of our markets here, it's been a very significant contributor. Taiwan stands out, of course. Brazil's pretty decent. In fact, most of these markets have delivered higher returns from dividends. We love returns from dividends because they are consistent and they help cushion the blow in any sort of down cycle. So you get paid your dividend every year. Yes, of course, dividends can and do get cut when you have a slowdown or a profit hit, but actually they are remarkably stable and they've been a remarkably consistent feature of returns. And that is something that is potentially or should be repeatable. So you would expect to continue receiving dividends. In fact, in many of our markets, companies are increasing payouts, rewarding shareholders with higher dividends. Korea is a particular example of that. And so your expected return from dividends should actually increase over time going forward. And that is, of course, the opposite of the green bar representing market re-rating. In other words, you can re-rate a market and it may well be justified. So in the US, we have seen expansion of multiples, and I'm not going to argue. Well, it's a whole separate story about whether that is justified or not. But it is not something that is repeatable on an annual basis because you can only re-rate up to a point, and it is ultimately a mean reverting function. So most of our markets have actually derated, are now cheaper than they used to be, or at least they're no more expensive than they used to be. So this is really the big setup. If we're looking ahead, we have this lower cost of capital, which we think will support returns by at least removing the drag from ongoing currency depreciation. We have superior dividend yields, and then we have to think about where earnings are, and we will come to that in a couple of slides. But just to kind of touch again on capital returns, of course, there's dividends, there's also stock repurchases. Very interesting point to note that in many of our markets, companies have been deleveraging and actually have very solid balance sheets. And China in particular stands out because we spend a lot of time talking and thinking about the enormous debt burdens in China, which sit with the local governments, which are, of course, highly unsustainable. They rely on the central government for support. It's a huge drag on growth and sucks in capital. But we can see that Chinese corporates have actually been deleveraging very aggressively and are among the most unleveraged companies in the world. That's not efficient, perhaps, from a balance sheet perspective, but it does mean that their scope to return cash to shareholders is very significant. And we can see how that's been reflected in a huge spike in capital returns. So you can see the deleveraging effect since 2018 has been accompanied by a big increase in share buybacks. And there's a relatively similar story to be told on dividends. So again, just to come back to this idea that from an income perspective, from a dividend perspective, share buybacks, actually emerging markets look quite nicely set up going forward. Now, to come back to earnings, we can see that this chart, just to explain, so this is the change in expectations for the coming 12 months in terms of analyst consensus. Don't always believe what analysts say, and they usually get things wrong, but it does give an interesting indication of what's going on within the markets. And you can see the beige line is basically telling us that analysts have been scrambling to revise up their earnings expectations for the coming year in MSCI emerging markets, not to a much higher degree than what we've seen in the US, which is perhaps surprising given the US is the big leader in AI and of course is where all the magic is happening. But actually in terms of earnings impact, we have seen a much bigger impact in EM. And yes, it is driven to a significant degree by technology stocks. So the dark blue component here, this is just decomposing that earnings revision figure. The dark blue component is information technology. It is primarily driven by, I would say, three companies in EM, Taiwan Semiconductor, that of course manufactures all those fancy NVIDIA chips, Samsung Electronics, and SK Hynix that make DRAM memory. And many of you will be aware, of course, of what's going on there. We have had a huge spike in DRAM prices, which is because we have an unprecedented situation where AI has shifted capacity away from traditional DRAM into highly specialized HBM memory, which is very profitable for these companies anyway. But it has reduced the supply while continuing to increase demand for the traditional DRAM memory, because it turns out that a big data center doesn't just need the fancy HBM memory that goes into the NVIDIA chips, but it also needs a lot of regular memory. When you guys are asking Grok or ChatGPT your questions, having a conversation, that conversation is stored in traditional DRAM memory, and there is an enormous appetite for it. So it's created a huge shortage of traditional memory. There is no quick way of meeting that shortage unless demand collapses. And so prices have essentially skyrocketed, and Samsung Electronics, SK Hynix are making incredibly large amounts of money. But we've run the numbers. Hynix and Samsung account for about 30% of the upwards earnings revisions in our markets. So it is a very important part of it, and of course it's part of a bigger picture, but there is also good things going on outside of that. So kind of the two takeaways are, one, that emerging markets are huge beneficiaries, probably the biggest beneficiaries of the AI capex boom, because all that money that Anthropic and OpenAI are raising currently. So you've probably seen OpenAI just closed a 110 billion funding round, Anthropic 30 billion. All of that money is going to end up in the pockets of Taiwan Semiconductor and Samsung Electronics and SK Hynix and the wider technology ecosystem in our markets. Those guys are selling these chips for cash, getting paid up front. There is no circular vendor financing. The money ends up here. So if there is a problem in the AI world, we would expect companies like NVIDIA to get hit because they are funding their customers. Companies like CoreWeave, OpenAI, that have low free cash flow, in fact, have huge negative free cash flow. And the people that are lending them money and investing in them, that is really the big vulnerability. On our side, you would simply see a reduction in demand, but the money has already been made. And hopefully, a good portion of that money has also been distributed to us as shareholders. So this is, if you look at kind of weightings within MSCI emerging markets, I would say around a third of the market cap of MSCI emerging markets is now information technology. It is arguably deserving of higher multiples than what we have traditionally seen in emerging markets. It's a different type of business, very, very high returns, very cutting edge, with pricing power, given they are the only companies in the world that do these things. But we have not really seen a big re-rating of MSCI EM yet. There has been a little bit, and you can see this is basically the discount at which MSCI EM trades to MSCI World. You can see it has been widening over the past 2 decades, and it has had a little bit of a narrowing in recent years, but it barely makes a dent on the chart. So earnings estimates and earnings growth in our markets have more than made up for, or at least made up for, the outperformance that we have seen. So there is still a value case to be made. There is a discussion to be had around how sustainable some of these earnings are if the AI boom comes to a halt, and that's a very fair point to make. But I would say that point applies very much globally, not just specifically to EM, and I wouldn't say that's a good reason to put an additional discount in EM. Of course, there are other things that happen in EM, as I'm very keenly aware of, being in Dubai, and that is, of course, why I think these markets do live with something of a discount. But then when you look at the policy making in some of the developed markets, in the US in particular, you have to also ask whether that discount situation is particularly unique. So I'll touch briefly on how that leaves us, where we're positioned. You may be surprised to see we are actually underweight information technology at this stage. That is to some extent a quirk of how the index allocates stocks. The real, I would say the real weighting is we're probably roughly equal weight with the index. We have been historically quite heavily overweight, both in Taiwan and in Korea, but we have been gradually taking profits as some of this DRAM and technology earnings growth story has been coming through. But yeah, I wouldn't focus on the underweight figure too much because some of our holdings are very much direct, but classified as but they're classified as industrials, for example. But and you can see that big overweight in industrials. But otherwise, we don't have particularly aggressive sector weightings. I think where it's interesting is perhaps on our country weightings. We have been very overweight Korea, as I said, historically also quite overweight Taiwan. Both of these have been declining, and you can see the combined weighting is broadly neutral, Taiwan and Korea. So that is that technology space effectively. We've been very underweight India, which has historically been a very expensive market. We have been reducing that underweight somewhat because India has been underperforming, but we remain concerned that valuations remain quite high. You can see we also have an overweight to the United Arab Emirates, which is clearly a drag at the moment. That is also a market where we've historically been very, very overweight, and it's something we've been reducing over the last year and a half, I would say. So there is some overweight here that is, of course, painful. And I think the UAE we have to accept will over the next 12 to 18 months have a hangover effect from the conflict that's currently going on in terms of a slowdown in growth. But again, it is an exposure that we have already been de-risking very, very significantly, and we're not particularly concerned about the size of that exposure. And finally, I'll just touch briefly, you will see here a Canada weighting. That is actually not Canada. We don't consider Canada an emerging market, but it's stocks that are mining, in particular gold and silver stocks that operate in places like Mexico, Colombia, that are listed in Canada. And that, again, has been a driver of returns over the last year, something we have been reducing fairly significantly over the course of certainly over the last 3 to 6 months. And frankly, we'll probably continue reducing because at this stage, we think gold and silver have become much more normal high beta risk assets than a proper hedging asset. And I have no idea where things go from here in terms of prices. So the buy case, or certainly the case to be overweight, is much reduced. I think I will pause there in terms of just talking at you, and perhaps there's some questions.
Thank you, Kamil. I appreciate that. Yeah, a few questions have started filtering through. One of the questions is, you kind of touched on it now, but the question is asked, is the current opportunity in emerging markets, so Asia, specifically Middle East is mentioned here, it's more than mean reversion. You've touched on a couple of the macro factors, but I suppose that's the question. Is it more than just mean reversion, and which sectors show promise?
Yeah, it's a good question. I mean, is it more than mean reversion? Well, what is mean reversion? Mean reversion happens when markets move out of sync with underlying fundamentals, good or bad. So outperform or underperform their underlying fundamentals. And I think if we look at the slide here and we kind of look at the really long-term big picture, we can see that our markets have delivered earnings growth. They have delivered consistent dividends and income, but returns have been dragged by both a derating, so people paying less and less for these earnings, and a big currency drag. If and it has, let's be clear here. It's been the right thing over the last 15 years has been to be as underweight emerging markets as you can, but everything in the US, it has paid off handsomely. There has been no reward at all for having exposure to emerging markets in the global portfolio. And so we understand why, first of all, people, global investors, are underweight emerging markets, which they still are, despite the flows that we have seen over the last year. And why those markets would trade at these big discounts, because why would you pay a premium for something that has consistently disappointed? So as that potentially now is changing, because as I said, some of those currency headwinds might revert. You have this potential for US dollar strength to abate. And of course, it's not just about that cost of capital. It is also about geopolitics. It's about the way people perceive risks from being invested in the US. Then people will need to look at these valuations again and see if there's an opportunity. So that is what mean reversion means in this context. Are people going to start paying the right price for some of these earnings, for some of these dividends? And we can't talk enough about these dividends because we really do love that feature of emerging markets, that kind of steady and growing income. We actually have an income fund as well, which Cameron, I think you're familiar with, which focuses very specifically on that and has delivered very spectacular returns with lower volatility. Because of that income component. So that's something that's there, that's built in as a returns driver going forward. And then all you need is people to actually realize that and be willing to pay up for it.
Yeah, yeah. No, I completely agree. I think that's maybe follows on to the next question then is there's obviously you've got big underweights in the likes of India and overweights in countries like South Africa. Obviously, there's more than that. But I suppose the question is then, if you were giving advice to an investor who's on the call today, and they ask you the question of, can we not just go passive? Obviously, we've got our view on it, but I'd love to hear your view on going passive as a way to access EM.
Look, I'm generally, I know the numbers just as well as you guys do in terms of global performance of active funds, and I've actually played around quite a bit with some of the numbers and some of the data that we have available, and I think for someone who is doing, setting money aside on the side without spending a lot of time researching funds, passive is a brilliant way to go on a global scale. What I think makes a difference, though, is that within emerging markets, there is far more opportunity to generate additional return from being an active manager, because our markets are more inefficient. And I don't mean that in a belittling way that they're somehow less sophisticated. It's because the investor base is so incredibly mixed. And you have retail investors pulling one way, you have domestic institutions pulling another, you have global investors coming in and going out, you have dedicated global EM funds like us that are able to compare Brazil to South Korea. And a lot of other investors aren't, because they're simply domestic, they're just looking at the domestic fixed income yields. And so it creates a lot of opportunity to take advantage of flows. We're very flows driven in the near term. In the long term, that has to all wash out. And that's where we step in and we're able to take advantage of valuation discrepancies. And so, we're sort of a case in point. We have, maybe it's luck, but we have outperformed the index 10 years in a row. So I don't want to say that it's easy to outperform the passive equivalent, but I do think that it is very much possible and should be possible given these kind of inefficiencies. So if you've got a good advisor who can pick good funds for you, then you should be able to access that alpha.
Or just going to the Cinnabon funds that already have these funds in them. just an option. Cool. So then one of the questions is, you obviously currently have an overweight to South Africa. I think for some of the most of the attendees, yeah, they'll be sitting here in South Africa with us at the moment. Who are the stocks you're owning, and what's kind of the base case for being overweight South Africa at the moment?
Yeah, South Africa is a market we like a lot. And I touched on this earlier, we look at the cost of capital, we look at domestic 10-year bond yields as a measure of risk and as a discounting factor that feeds into all our models. And we know that in South Africa, this has been declining on a very nice, steady basis. South Africa historically has been among the higher cost of capital markets for good reasons. And of course, has also struggled with currency weakness and so on. As that's reversing, we want to be exposed. Now, South Africa isn't traditionally a value market per se. So you guys have a very developed capital market with some incredibly well-run companies, and those have always commanded a premium, and we understand that. So it's been, there's been many years where, while we didn't have that particular tailwind from falling capital costs, we were pretty underweight South Africa. So this is fairly new for us, that we've got a significant position which we built up, over the last, say, 18 months. What we have is, you guys aren't going to think is that exciting. We are constrained somewhat by liquidity. We have been in the banks, so we have been in ABSA and in FirstRand, really driven primarily by valuations. ABSA, perennially a value trap, is starting now to potentially turn around, and actually it's been the better performer. We also have Vodacom, which is a nice and steady beneficiary of this kind of idea of lower rates. There's a dividend play, there's a bit of an Africa growth play, which we like. And then we do also have, which we don't in our minds consider part of South African exposure, we do have Naspers. That is, of course, really expressing primarily a view on Tencent, which has pulled back, which has derated from historically being a very premium internet stock in China, and it's an area that we follow very closely. So we get that discount, of course, built in, and that commitment to narrowing that discount that Naspers is actively working on. So that's our exposure there.
Yeah, it's actually interesting, because I think most people in this call would probably be expecting you to be holding some of the gold company, the mining companies. But it's interesting. I believe you don't actually hold any, and it's more in Brazil that you finding those companies.
Yeah, that's an excellent point. So you could argue our South Africa overweight is in some ways bigger, because we do not hold any of the miners. We've had quite a lot of success in picking slightly smaller, more focused mining companies in South America. I mentioned earlier this Canada weighting, that is effectively, you could think of that primarily as gold or precious metals. And while, of course, many of the South African names have performed extremely well, we've had some of these companies that are significantly growing their production, that have real expansion, organic expansion potential, and are also lower cost operators than the South Africans. They're oftentimes open pit miners rather than the deep undergrounds. So yeah, we've been pretty happy with our gold exposure. We've simply gotten it elsewhere.
Yeah, no, very interesting. Okay, there's, I think, two questions that I want to touch on. The first one is, you obviously factor in dollar prices because you report in dollars for the funds, but how much are you paying attention to kind of the structural decline of the dollar? And so as a view to how you expect the dollar to kind of continue to weaken, or do you think it's going to strengthen from this point? And then a question was also asked then, if I'm already in dollars, should I be concerned?
So I hate making currency forecasts, but certainly in the short and medium term, because I think it's an impossible task. But to step back to our philosophy, we generally think that if you're comparing two currencies and one of them offers you a much, much higher yield, don't expect that you're going to make money by owning that currency over the other one over the long term. It may work incredibly well over 3 months, 12 months, even 24 months. So the dollar today, well, historically, the dollar, of course, has benefited from a much lower yield than any emerging market currency. And so if you were in South Africa and you're putting your rand into dollars, there was a surefire currency appreciation built into that, even though your yield that you were being paid was clearly much inferior to what you would be getting in rand. Today, that is less true. And so again, we don't think this continued strengthening in real terms of the US dollar is likely. There's going to be a lot of volatility around it. And at a minimum, what I'm doing with my personal money is I'm just making sure that I do diversify away from having too much of my savings in dollar or dollar linked currencies. Of course, not that easy to do. In the fund, we have the luxury of essentially converting all these dollars into all these interesting emerging market currencies, many of which we expect to, over time, hold their value or strengthen against the dollar. And so we're pretty relaxed about that. But it is a factor we consider. Of course, some of our markets do have currencies tied to the dollar, which historically has been a benefit. Today, less so. I'm not going to go as far as saying it's an outright negative, but it's certainly no longer deserves a premium over markets that may actually see currency appreciation over time.
Yeah, 100%. That's also what we'd be saying from a civil perspective is, if you're looking at short-term time and currencies, then good luck. It's not worth the effort. Yeah, no, exactly. It's not going to be a main driver of returns anyway. So if you are invested overseas, definitely do not bring it back in South Africa. Lock in the stronger rand and the weaker dollar. Do not do that. It would be my suggestion. All right, perfect. Well, I think, Kamil, I think at this point I'm gonna say that we should wrap up. Thank you. Thank you for joining us. I think you did yourself a disservice by not having or saying that your camera wasn't worth being on. Very good looking individual. I mean, genuinely, thank you for being here today. Yeah, there's been lots of questions, so thank you to everyone for engaging with us, for joining us for the session again. Yeah, we hope you have a fantastic rest of your Thursday and an awesome Friday and weekend to follow.
Great. Well, thank you so much for having me. It's been a pleasure.
Yeah, been awesome. Thanks, Kamil.
Thank you. Bye-bye.
Bye-bye.